Most people don't value stocks, they guess. That is why I developed this discounted cash flow dashboard, which has a simple interface but a serious valuation engine underneath. This dashboard is built on the intrinsic value principles taught at the NYU Stern School of Business and popularized by valuation professor Aswata Madhuran. Cash flow, growth, and risks are all embedded in this model. It will ensure that you calculate the intrinsic value of a stock correctly. What you need to do is put in your assumptions. So no more do you need to guess what a stock is worth. You could calculate it yourself. You don't need to be an expert. As I said, all of the formulas underneath are doing the heavy lifting. You only need to put in your assumptions. Now, in this video, I'm going to demonstrate how easy it is to value a company, and we're going to value Meta. What we need is to have a discount rate before we can discount the cash flows. So here you type in the company name using Meta, and the discount rate is a combination of equity and debt. And in valuation, the only thing we need is the market value. We don't care about book value in valuation. So first, we start with the equity portion. Here, the dashboard has imported all of the required data to calculate the discount rate. However, though, we'll need that you input the data for it to calculate the discount rates. And here you have the input fields. Industry, I need to choose what industry Meta operates in. Here I'm going to choose advertising, and the reason is the majority of the revenue source coming to Meta is from advertising. Secondly, it will ask you about the risk-free rate. In that currency, you're valuing the company. So given I'm valuing Meta in dollars, I need to add the 10-year government US yield, which sits at 4.5% today. Then it will ask you what is the equity risk premium of the country that the company operates in. For US, it was 4.2%. We have the book value, which sits at 86 billion. And here we have the interest expense. And what the engine does here is that it treats the debt as a bond. And the interest expense here will act as a cash flow, and then it will convert it automatically to market value. However, though, we need to give the model the maturity of the debt when it expires. Here, I'm just putting 3 years as an example. Here it asks you, does the company have an actual external credit rating, or do you want me to use a synthetic rating? If you choose a synthetic rating, my model will calculate a default spread automatically. However, though, I know that Meta does have an actual credit rating, and it's double. So the spread for that is 0.6%. Then it asks you what is the tax rate. 25 will not change that. And then finally, if we have any preferred stock, we don't in this case. Now we're done. You have the discount rate, 8.53%. Now we move on to the dashboard. Here is where you could visualize the profitability, growth, and risk of that company. And here the dashboard will give you warning signs if it finds any. Here you can see that growth is green because revenue is growing. Then you have the annual average growth rate for Meta, which sits at 20%. And here the dashboard is telling you, hey, Meta is a high growth company. If you would have a declining company, it will give you the warning sign. This is really important so you don't overvalue the company. Next, here we have the profitability ratios. And this is what is called economic value added. So this looks at what the return on invested capital for Meta is, and it deducts the required rate of return, which we calculated most recently, which was 8.5%. And the difference is the net is 19.6%. So meaning that Meta is growing and adding value to its shareholders. In contrary, if you would have return on invested capital below cost of capital, then this would be red. And that would mean if your company is growing, then it will destroy shareholder value. That is why I have this here. This is really important. And many investors see cheap companies, but it's just a value trap because return on invested capital is below their cost of capital. And here you won't do this mistake anymore. Here you have earnings shares trend. Here it looks at the diluted earning per share. And in many American stocks, you have stock-based compensation, which is the dashed line here. And here you want to keep track of this not increasing year by year, because what happens is you will be diluted as a shareholder. And then you would probably see that stock-based compensation is growing, and then diluted earnings per share is decreasing, that would be a warning sign. But here you could see that earnings per share are growing. So nothing we need to worry about. Here is just simple price to book. You have it in the dashed line. In the bars here, you have PE ratio. Here, debt ratios, red, long-term debt, orange is short-term debt. And here to the right, you have the short-term repayment capacity. This is really important. Even though you're valuing a company, you need to control for risk. Now here you can see that Meta sits at $81 billion in cash, and it has a short-term debt of 2.4 billion, which is due within a year. This says to you that, of course, short-term repayment capacity is not a danger. Meta will be able to meet its obligations. In contrary, if you would have short-term debt higher than cash, my dashboard would give you a warning. Here you have cash per share. Given that Meta has more debt than cash, then cash per share becomes negative. And finally, the most important thing is the free cash flow. Here on the top, you have the free cash flow. In orange, you have the working capital. And here I'm calculating free cash flow according to Professor Aswathamadharan in valuation. Because free cash flow is what is called unlevered cash flow. It's pre-debt. Many models that I've seen on internet is calculating free cash flow incorrectly. Here also, I have not taken into consideration stock-based compensation because many companies will add back stock-based compensation and that will inflate free cash flow. So here you don't need to worry about that. Here you're going to get the true free cash flow. And on the bottom, you have the reinvestment. Because here it's also important to look at reinvestment so that the company is not reinvesting too little into their business, and that's why they're inflating their free cash flow. And here we can see that Meta has invested $49 billion into their business, and that is in the form of working capital and capital expenditures. And still, they were able to pull off free cash flow. That shows you how strong a cash flow machine Meta really is. And finally, we go into valuation. Here you have the stock price, and here you need to calculate the value. But before we do that, we need to put in our assumptions. Now, in this table, we have AI giving you what the industry averages is to the right-hand side, and to the left-hand side, you have the company metrics. So if we start here, we can see that Meta grew annually 16.5% in the last 5 years, whereas the advertising industry grew only at 7.7%. And then if we look at the gross margin, you see here that Meta sits at 81.9%, whereas the industry average company sits at 34.8%. It's 47 percentage points higher than the average company within the same industry. And here you can see that the AI has told you that the company shows strong profitability, capital efficiency than the industry, with a higher reinvestment intensity than the peers. And of course, we know that Meta is now investing really heavily in AI, and that is the reason to why the reinvestment has been so high. Here, the company input, my dashboard has automatically imported the required data. Now, of course, you can override these numbers if you feel, for example, that you have a write-off that shouldn't impact EBIT going forward. You can do that. You can just press manual, but I'm not going to do that in this example. Now, value drivers, revenue growth. Given that Meta has grown by 7%, and I model based on the reinvestments of Meta is expecting Meta to grow by 16% next year, I'm going to put 16% here. And it asks you what will the operating margin be for next year. I'm just going to choose the current EBIT margin, Meta, 41.2%. Revenue growth years 2 to 5. I'm going to choose 15%. And it will ask you what you believe the target pre-tax operating margin will be for Meta in year 10. I believe that competition will grow, so therefore profitability will decrease as well. Let's put 40, and it will converge in year 10. Here we have sales to capital. The higher sales to capital, the more capital efficient the business is. The lower sales to capital, the less capital efficient the business is. So if you put 1.5 here, it means that for every $0.5 in revenue Meta gets, it needs to invest $1. And I'm going to put 1.5 here as well for year 6 and 2. Now you're probably wondering, what is the right number? Well, let's look at the cash flow board. Given we have 1.5 and 1.5 here, we have a reinvestment rate of 32%. But if we look up here, we could see that the average reinvestment rate for Meta sits at 47%, and the average reinvestment rate for the industry sits at 10%. But given now that Meta will reinvest heavily in AI, I need to put it at higher. So it sits at 40%. So let's do like this one. Now we have it higher, and then I believe it will decrease to a lower state. Marginal tax rate 25%. Now finally, we can look at the dashboard, and here is all my inputs. I put revenue growth 16%, 15% for 5 years, and then it will decrease down to the risk-free rate. So I'm assuming that Meta will have a revenue of 690 billion from current 249 billion in year 10. Operating margin 41.2%. Given the increased competition, I believe it will decrease down to 40%. And finally, my models, if you here look at return on invested capital, that's a really important figure to consider. Because if you're reinvesting too little into your business, your return on invested capital will go too high. That will become unrealistic. Because as more you're investing into your business, return on invested capital will become lesser. If we look here, 32% year 10, and we look at the average of Meta sits at 35%, I'm not going too high, I would say. Now, as default, return on invested capital will equal cost of capital in year 10. And you're probably wondering why. Well, McKinsey has made a study which shows that as the company matures, it will have a difficulty of earning higher than its cost of capital. Competition has increased, and it has a lot of more competitors, and it can't then hire the prices of their product. But since Meta, I believe, is a unique business, I will override this assumption. I will put 15% here. What this will do is that it will reduce my reinvestment rate here in year 10. Now I'm done. Here we have the operating value of the free cash flows that we get. Here we have the debt that we'll deduct for, and then we'll add back cash. So let's see what the value is. Given my assumptions, I get that Meta is devalued, and it should be valued at $807. Now you can click export, and then you can get the DCF in an Excel, and you can also get this in a PDF report. That's how simple it is. Start becoming a value investor and stop guessing what a stock price is worth. Hope you find this session interesting, and I hope you become a member so I can teach you more about valuation.